Let's get started. Let's get started. All right. So, welcome, y'all. You already know what it is, Passive Income University. And this is our weekly prep slash strategy meeting to get us prepared for the oncoming week. And this week is going into April 29th, 2024. Now, before we kick it off, we've got to read that disclaimer. So, disclaimer slash disclosure. The information presented in this trading course is for educational purposes only and is not intended to provide investment or trading advice. The course is designed to provide general information on options trading and stock investing and should not be considered as personalized investment advice or a recommendation to buy or sell any securities. The course content is based on the experience and opinions of the instructors, and we do not guarantee the accuracy or completeness of the information presented. Options trading involves significant risk, and it is possible to lose money. Any trading decisions you make are solely your responsibility, and you should always conduct your own research and analysis before making any investment or trading decisions. We do not guarantee any specific trading results or profits, and past performance is not indicative of future results. Trading options involves complex financial instruments, and it is important to understand the risk involved before making any trading decisions. We are not registered investment advisors or broker dealers, and we do not provide any investment advice or recommend any securities. We strongly recommend that you consult with a licensed financial advisor or broker dealer before making any investment or trading decisions. By accessing this options trading course, you agree to the above disclaimer and understand that the information provided is for educational purposes only. You also agree to hold harmless the course instructors and their affiliates, partners, and employees from any claims, losses, or damages that may arise from your use of the information presented in this course. All right, so with that being said, we can get it rolling and get it started. So, like I said, this is the preparation for the week of April 29th. So, going into April 29th. And what we're going to talk about today is my investing approach or thesis, if you will. So, basically, me restarting my portfolio and what I'm looking for in new companies and holdings. Then, we're going to touch on a broad market analysis, looking for bullish and bearish levels in the market. After that, we're going to cover the economic reports and events that are coming up this week. And then we're going to get into some charting basics, just understanding some of the tools that are available in TradingView. And then lastly, we're going to talk about some options mechanics, things I look out for when it comes to options trading. All right, so let's kick it off with the first one, my investing approach slash thesis. So there are four key components when it comes to my investing approach or thesis, if you will. Now, starting off over here at the top left square, I have the top two of the 11. And simply put, it's identifying the top two companies in each sector, AKA, I call this the 211 approach. So there are 11 sectors in the stock market. And my goal is to identify what I believe to be the top two companies in each sector, which should put my portfolio at about 22 companies. Now, let me give you a little bit of background and some more info on why I'm taking this approach. If you ask most, in my opinion, transparent, forthright people that really have your best interest at heart, mind, and spirit, they're going to say the cheat code to investing is to simply go ahead and invest in an ETF like the VOO or the SPY that follows the broad market, right? As well as QQQ, which is more so for like technology stocks. And so ETFs or exchange traded funds, you can look at them as like a basket of the best performing stocks. One example that I hear a lot is think about the all-star team for the NBA, right? The best players on one team. And I completely agree with that approach. So if you don't want to get into rolling up your sleeves, getting into the weeds of really researching companies, but you do understand the value and the importance of investing, then you just want to find an ETF, go ahead and invest, take a set amount of each paycheck or whenever you can invest and buy shares of that particular ETF. Now, if you're ready for the next level, I would say take this approach, the 211 approach, where it's going to offer you some diversification, kind of what you're going to get when you invest in the ETF, but it is going to put a little onus on you to get familiar with the stock market, get familiar with researching companies, but not go overboard, right, with your portfolio. So, like I said, there are 11 sectors in the stock market. I'm looking to find the best two. This is going to push me to continue to evolve and increase my stock market education and knowledge level, as well as give me some broad market diversification. Now, the next part or approach in this thesis is global exposure over here at the top right. And so, part of my criterion now, or part of what I'm looking for when it comes to companies, is do they have a nice global footprint? Or are they just relegated to one part of the world or one country or one continent? The more exposure they have globally, the better. And then, of course, over here at the bottom left, do the companies pay an increasing dividend? Now, there is a lot of back and forth, a lot of argument on whether or not you should look for companies that pay dividends, if you just should focus on companies that have the growth that are kind of already implemented in, meaning that they're saving the money that they would be paying the shareholders in dividends and just using that to further increase the stock price. But for me personally, and this is just my own individual approach, I need to get a little bit of a kickback along the way, right? Now, before, my main approach was just finding companies that were steady dividend payers. They had just a solid dividend performance historically. But now I'm leaning more towards companies that will have that expanded growth in the share price, even if the dividend is minimal, right? Because we know, especially if we dig into their financials and the research and the reporting and things like that, that over time, as the company grows, then more than likely their dividend is going to grow. So instead of me looking for a solid dividend yield or something that was relatively high, I really don't care now if the dividend is low. I just want to make sure that the company is projected to grow. And basically, like the tail end, the dividends will follow. And then lastly, over here at the bottom right, is there a technological moat? Are they tangibly implementing technology to increase their competitive advantage? So what you're going to hear and what we're all hearing right now is a lot of these buzzwords, right? When it comes to AI, whenever companies kind of wanted to boost, if you just go back to last year in 2023, if it was their earnings time, if they wanted to have the stock run up, all companies had to do was say, oh, we're going to be implementing AI and we're going to use AI to do this, AI to do that. And things were running off the charts, just going crazy. Well, I'm looking for strategic, tangible actions that show that they're increasing their technological advantage, not just saying it. So when you look at their financials and you're looking at their balance sheet, you're looking at their accounting, I want to see some huge capital expenditures saying that, yeah, we just partnered with either Google or OpenAI, and we've got this many millions or billions invested in developing our AI platform, or we're working on our own GPT, or we're working on our own product. And this is what we got working on. And we're hiring all these programmers and all these language models, things like that. What are they really doing for their company, their sector, their industry to really increase their technological moat? And let me kick back for a second and take a look. Let's see if we got anybody that joined. Definitely want to show love and make sure. All right, we're just rocking solo dolo right now. Let's go ahead and get going. All right, so here's a quick portfolio update. These are my holdings as of today. Like I said, I did restart my long-term dividend income portfolio, and currently these are the companies that I do have. So we've got Caterpillar, we've got Booking.com, we've got ADP, Visa, Microsoft, Costco, and Maine. Now, one thing I quickly do want to spot out on the heels of what I just said I was looking for, Maine is the only one that is an outlier that does not fit in most of those requirements or criterion that I just described. It is a US based company that, to the best of my knowledge, doesn't have any exposure to the global world. There isn't any footprint anywhere else. But this was one of my favorite companies back when I originally had them in my dividend portfolio last year. And their ability to offer bonus dividends, increase their dividend, and pay a monthly dividend was quite stellar in my opinion. And the stock price has done pretty well. It's been almost stagnant with some slight growth, but I do make an exception for Maine. Other than that, I will be sticking to what I just described in that previous slide, just breaking down all that criterion. Now, the newest addition here shaded in this rectangle, this green shaded rectangle, is Booking.com. And one thing that I want to note is I'm also looking for companies that have somewhat of a monopolistic advantage as well. And in doing some research, I realized that booking.com is dominating the online booking tickets, hotels, travel space, if you will. So I want to take a moment and just kind of dig in deeper and show us all what really caught my eye when it came to booking.com and what I saw. So if you know me, if you've been on any of my lives, if you've heard me talk to different people when it comes to researching new stocks, you know that I always start off with this website, seekingalpha.com. All right, so we want to look for booking, which is ticker symbol BKNG. And so before we get into the numbers, I want to just read this summary to you in terms of having a global footprint, competitive advantage, and let's take a look at this company profile. It says Booking Holdings Inc., together with its subsidiaries, provides online and traditional travel and restaurant reservations and related services in the United States, the Netherlands, and internationally. So we've got somewhat of that global exposure there. The company operates Booking.com, which offers online accommodation reservations, and Priceline, which provides online travel reservation services, as well as consumers, hotel, flight, activity, rental car reservations, vacation packages, cruises, and hotel distribution services. It also operates Agoda that offers online accommodation reservation, flight, ground transportation, and activities reservation services. And in addition, the company operates Kayak, an online meta search service that allows consumers to search and compare travel itineraries and prices. Open Table for booking online restaurant reservations, as well as reservation management and services to restaurants, and rentalcars.com. So I want to read a little bit more, but I'm hoping you're getting the idea here that with booking.com, they are pretty much dominating most of the popular, well known platforms that people use to book any types of travel reservations, whether it's flights or something as simple as booking a reservation for a restaurant. Now, not to let any of this sway you, but we can see here that both Seeking Alpha, Wall Street, and Quant Analysis all give booking.com a buy. But that is just step one to give you a little bit of the background. Now, as I always say, do not let the share price of a company deter you or sway you from investing. Most platforms allow you to buy fractional shares, and that's the number one way that I purchase my shares on a company. It's very rare that I'm buying whole shares of anything. I buy what I can with the money that I have on hand. So with that being said, as of today, booking.com is just over $3,500 a share, but take note here that within the past year, it's up 35%. So just beware of that. Now, the second thing that I look for when it comes to investing in these companies are, of course, the dividends. So I go to the dividend scorecard, and it appears at first glance that booking.com just recently may have announced that they're paying a dividend. And the reason why I'm thinking that is because they've got 0 years of dividend growth, and there's no data on their payout ratio or their 5 year growth rate. So that had me thinking to myself, is it new, or is the financial information in regards to these numbers here just not available? And one thing that told me that it's new is when we go to the dividend history for booking.com on Seeking Alpha, which we can see they only have one dividend that was paid or announced, which is a quarterly dividend for 2024 at $8.75 a share. So this is telling me that they're just now starting it out, and they're at a place where they have enough cash and capital on hand to start paying it back out to their investors. So one thing that we're seeing, especially now, it's a very exciting year when it comes to dividends, is a lot of these companies that are dealing with billions and billions and billions of dollars of cash are now having to find ways to get rid of that cash so they can avoid the tax implications that comes up with it. And we saw that earlier this year, just a few months ago, with Meta, aka Facebook, with Mark Zuckerberg. They had so much cash that they're dealing with. They announced that, hey, we're going to start paying dividends, which is a way to lower their tax burden and reward their shareholders. And then, just as of this past week, Google, finding themselves in the same position, plenty of cash on hand, is saying, hey, one way that we're going to deal with having so much cash is to reward our shareholders in the form of a dividend. With that being said, I'm looking forward to hopefully Amazon announcing that they're going to start paying dividends this year. So after I take a look at the dividend scorecard, the next thing I want to take a look at is their financials. Now we're going to go tip of the iceberg. We're going to roll up our sleeves just a little bit, but I want to show you all the main things that I immediately look for when it comes to the financials of a company and adding them to my long-term portfolio. So within Seeking Alpha, and this again is another reason why I want this, or I always start this as a starting point when I'm researching a company. So we go over to the financials tab and then we click on cash flow. And so cash flow will immediately bring us to the company's net income. And so you want to go back as far as you can, as we can see that there is a paywall going back more than 5 years or before 2019. So after you look at this analysis, if you go back 5 years and you want more info, then the next place you want to head for free is the company's direct website. And you want to look at their earnings reports or their accounting reports from there. But here, Seeking Alpha is just going to give us a nice quick rundown. So in 2019, Booking.com had net income of $4.8 billion. That's profit. So net income is one of the many synonyms, depending on what you want to look for in terms of the profit a company makes. And then in 2020, that 4.8 billion disappeared and dropped to 59 million. But we all know why, right? The pandemic hit. And 9 times out of 10, when I'm researching a company, I always give them a pass on their 2020 financials. Here we see in 2021, they got right back to it with 1.1 billion in profits. 2022, it grew to 3. 2023, it grew to 4.2. So they're steadily on track to get back to where they were in 2019 if they haven't already got back there. So in my book, that is a nod in the right direction and a thumbs up. So first line item we're looking for is the net income. And then the next thing we want to take a look at is what's known as the free cash flow. So we have two kind of components or versions, if you will, the unlevered free cash flow and the levered free cash flow. You could take a moment to read the definitions here. As a matter of fact, I'll do it. So the levered free cash flow is the amount of money a company has left remaining after paying all of its financial obligations. It is the amount of cash a company has after paying its debts. And then on the opposite side, the unlevered basically says how much money do you have on hand without accounting for paying your debts. And one way you could think about free cash flow and why it's so important is because think about it in terms of getting paid every 2 weeks, which happens for most of us, right? But then having bills that come up before you get paid every 2 weeks. How much cash do you have on hand to knock out those bills? And that's why free cash flow is important, because if you don't really have any cash on hand, then you're having to get into more and more debt to take on those unexpected bills that pop up in those 2 week periods before you get paid. And so what we can see here is that their free cash flow since 2019 for the most part has grown. We already notated that 2020 was upside down and the pandemic rocked all the businesses. So we'll skip over 2020. But then in 2021, we got 3 billion in free cash flow. 2022, 5.7 billion in free cash flow. And then they broke above 6 billion in 2023. So free cash flow is going, meaning that they got cash on hand in their pockets just in case something wild happens that they can take care of. So that was really the long and short of really what had me on. Let me go ahead and take a deeper look at booking.com to get their added to the portfolio. The next thing that we want to do is we want to go directly to the company's website to see what they're saying on their financial reports, because they will kind of give insight to some of their struggles, their challenges, their risks, their guidance on where they see their future in the markets and in the economy and the global economy. And then you also want to compare them to their peers. So the dope thing about Seeking Alpha is you can go over to the peers tab and it's going to show you other companies that are kind of in line with that company. So Seeking Alpha is saying a peer or a competitor to Booking.com or Booking Holdings is Airbnb, Marriott International, Hilton Worldwide, World Caribbean Cruises, and Trip.com. So if you wanted to kind of compare and contrast and make yourself sharper, you can go ahead and check out their peers as well. Look at their financials, see if they offer dividends, and see what other things are important to you. Now, it's pretty much the same thing. Like, we'd even see some stronger numbers if we look at these other companies that are in my portfolio currently. ADP, which is a payroll services company, one of the biggest in the world. According to their own data and statistics, they provide payroll services for 1 out of every 5 employees in America. Visa, which is arguably the biggest payment processor in the entire world, they recently had some information come out that said that amongst themselves, or really their competitors outside of MasterCard, They don't have a competitor. The only thing that's competing with Visa is cash and checks in and of themselves. And as we all know, cash and checks bit by bit are slowly to dissipate, slowly going away. It is going to be a long process as we trudge forward into a more computer technologically driven world. But according to Visa and the way they're looking at the world, they have another $20 trillion that they can get access to that the world is still using in terms of physical cash. All right, let's do a double check, see if anybody has joined us on the Zoom. All right, still rocking solo dolo, and we can keep this rolling. All right, and a reminder, I've been pumping this, super excited about it, is the Passive Income University Investor Bingo card. So this is going to be an ongoing challenge, and the first person to make bingo in any row, up, down, diagonal, left or right, will win $100. And the purpose behind this PIU investor bingo card is to keep us motivated to invest and accumulate assets for our future. So I want to go through each one of these squares because I don't think I've ever done this before, just explaining each one. So we'll have this record to come back to just in case anybody needs to have some information about how the bingo card works. So in this top left square over here, we have the one REIT or BDC, and this pertains to a type of company that you can invest in. REITs or REIT stands for Real Estate Investment Trust. These are companies like Realty Income, ticker symbol O, LTC Properties, ticker symbol LTC, Well Tower, American Tower, things like that. And REITs are companies that typically are going to be paying monthly in dividends, or a BDC, which stands for a business development company. And these companies are companies that specialize in helping other businesses merge with or buy other businesses. Now, you may recall just on that previous slide on my portfolio update, the one outlier that I have, which is Main Street Capital. Main Street Capital is a BDC or business development company. So if you have one of those, you could knock off this bingo square. And then there's two sources of passive income. This is pretty straightforward and simple. So if you have dividend stocks, if you've got a rental property, if you've got interest from a savings account, if you've got your own business that has a passive nature to it where you're getting paid, very easy, just making sure you got two sources of passive income. $1,000 invested in your Roth IRA, $500 invested just in your general brokerage account, signing up for the PIU affiliate program, which we're going to touch on at the end of the breakdown in the strategy session, the weekly prep today. Two companies from each sector, which I already told you and showed that is a part of my investing thesis and strategy now. So there are 11 sectors in the stock market. If you get two from each, your portfolio should be right around 22 companies in your portfolio. Next up is portfolio has at least two companies that have increased their dividend this year, or you could look at it in the last 12 months, right? So if in the last 12 months, two of the holdings in your portfolio have increased their dividends, you can go ahead and mark that square off. And then we've got $100 PADI. Now, if you don't know what PADI or PADI means or stands for, that stands for projected annual dividend income. So if you look at how much you should be getting in total from all your dividends for the year, once you get to $100, you can go ahead and mark that off. The next square that you should aim for, could aim for, or might already have, is 10 shares in every holding. So let's say you've got three companies currently in your portfolio. And if you've got 10 shares in each one of those, you could knock that one off. Another opportunity for bingo is 100 shares of one stock. And then I also have one holding in each sector. So let's just say you've got a few companies in your portfolio and you're trying to find the best one in each sector. You can knock that off once you get to one in each sector. So you should have 11 companies in your portfolio. An easy one to win is an auto deposit for your investing. You can knock that off right away today. $1,000 invested, $2,500 invested, $250 in PADI or projected annual dividend income, and then lastly, a monthly dividend stock. So some of these could immediately take out multiple squares for you, right? Or you could just do a couple of things that ain't even associated with money and get some squares knocked out, like signing up for the PIU affiliate program and doing auto deposit for your investing. You could easily do those two, get those squares knocked off, and not have to worry about moving any money around. All right, so let's do a broad market analysis. And this is just going to be a quick touch base on pretty much where SPY is at in this moment in time. Let's see, right here. We'll bring up trading view. All right, so I already marked out the chart a little bit. I'll let our eyes have a moment just to see what it looks like. And then I'm going to take away the drawings and redraw them and explain what I saw and what I see. But we're currently looking at the daily chart for SPY. And if you don't know what SPY is, it is an ETF, arguably the most popular one that follows the S&P 500, which is a broad kind of gold standard for measuring where the stock market is at and how the stock market is doing. So give your eyes just a few moments and then I'll remove the drawings. All right, let's go ahead and remove these drawings. Now, like I said, we're looking at the daily chart on SPY. And what we see, or at least what my eyes immediately see were two recent trend breaks, right? So if we kind of take this low point back in January, the start of the year, we see that the market was already somewhat going into the start of the year an incline, but it had a couple dips, which kind of almost broke the trend, depending on how you draw your trend lines. But we're going to just use that as a starting point to get our eyes kind of calibrated. So what we would do is take this trend line here from this particular day and then just kind of draw it up across the board, see where we have some touches. Boom. And then what we can see, I'm going to go ahead and change this line to green. What we can see is that SPY, or the market, trended up all the way through the beginning of this year, pretty much since the beginning of January, even though we have our starting point at January 17th. And then it broke the trend. Once it broke this trend, this is where you could see an opportunity on this bearish outside candle, this 3 candle right here, to take puts. And so you want to draw another trend line. Maybe I should have called this section more so drawing trend lines than anything, to create another trend. All right. We've had this downward trend, which we will kind of make it just a little tighter, and we'll change it to red so we differentiate. Let me turn off this wedge maker indicator. All right. So turning off the wedge maker indicator, we notated that we've got this trend line from the beginning of the year that showed the market going up. It broke that trend, and we've got this downtrend where you would take this opportunity to get in puts anywhere here. And let me make a note to say that this is more of a long-term approach. So we're definitely not talking about scalping, and we're not talking about day trading. This is putting ourselves in the zone to swing trade for days on out, weeks on out, if not months on out. Here we are in a change in these trends going back to January. Here we are 4 months out. So one of the things we've been kind of talking about in PIU, if you've been aware and been on top of the Discord, is this idea of getting more into swing trades, and more specifically into leaps. And leaps are options contracts that expire either next year or 4, 5, 6, 7, 8 months out, something like that. So keep that in mind in this kind of overall macro trend. But we got this upward trend. It broke. Once the trend broke, you might even think on this candle right here to take puts. And then we got this downward trend that just recently broke going into the weekend. Our last day right here was Friday. And now we've got a trend coming back up to the upside. So now we can draw another trend line right here and draw some points. And this is a very, very interesting position to be in if you're not already in a play. If you're just kind of looking at the daily chart and wondering where the market might go. Because even though, based off of our trend lines, this downward trend has now broken, that originally kind of started, if you will, at the beginning of April, April 4th. It is now kind of broken. It was a little choppy this week, broken back up to the upside. Now, there's one thing I would keep in mind before, if you were just to use this as a broad form or rough form of technical analysis, I would be very, very aware and have this at the forefront of your mind because here we are at the end of April, going into pretty much May, right? We've got one more business trading day left in the month or two. Is that there is an old adage, old phrase in the stock market that says sell in May and go away. So one thing that you might consider doing is going back to May of last year and previous years just to see if we've had any dip in the stock market. Now, there's also another resource that you might consider looking into, and we'll see if the green screen can pick this up. But is this book right here, the Stock Traders Almanac, and this goes into those very cyclical and seasonal trends and yearly trends that we see with the market. That also talks about that kind of downpour, that downtrend in May, that sell in May and go away thought process. But what I would say is, depending on how tight and how you draw your trend lines, look for a couple of touches before entering into either side, whether you're looking for a bullish side on the up or a bearish side going downward. Look for some touches on your trend lines. As we can see here, we've got 1, 2, 3 touches. So this fourth one would have been a good one to get in some puts. And on the other side of the flip, we've got maybe 1, 2, depending on how you want to count it. I would look for maybe another third touch before considering some calls to the upside and then playing it very, very tight when it comes to our stop loss. But very easy to see these trend lines and see how they broke out and how they change. We had a quick 2 pivots on the month coming up from that trend up, down, break it to head back up. And then definitely being very aware and cognizant, because this was the all-time high for SPY in the stock market in this area. Let me go ahead and move this over here. So right around the $524, $525 range is all-time high for SPY, which once we get there, we might get into uncharted territory and the stock could really run, or the sector of the market could really run, I should say. All right. And so we've got this week's economic events. Now, there are a handful of economic events coming up for this week, but there are some very important ones that I wanted to spotlight out, starting off with ADP. And these are the employment numbers. So just imagine this is how important ADP, which is the company I already spotlighted in my dividend income portfolio, my long-term investment portfolio, is. ADP, like I said, deals with most of the nation's payroll services. And because they deal with most of the nation's payroll services, they're in this very unique position to where their data, the information that they have, is important enough to be considered an economic event for the American economy. And as a result, ADP releases numbers on a consistent basis to the government, to the Fed, to the American public about employment numbers. And so employment numbers can be a market mover, but can go either way depending on market sentiment, especially on a company to company basis. So we're going to touch on that once I get to the end of the economic events. And then we've got FOMC, which is the interest rate decision. So Jay Powell and the Fed once again are going to be talking about what they plan to do with interest rates. They will announce if interest rates are going to go up, down, or staying the same. And this is definitely going to be a market moving event, especially in the micro. So as Jerome Powell is talking, if you're new to this type of experience or event with the stock market, we're literally going to see extreme volatility and spikes in the market while Jay Powell is talking. So keep that in mind. And for us new traders out there, and for most traders, it's best just to not trade on this day, and definitely not while he's talking, and just waiting for the dust to settle once his speech is done. Another thing that we want to be on the be on the lookout of is the Consumer Confidence Index. And this is a leading indicator of the economy's strength. It's based on a survey of 5,000 households that ask questions about their confidence in the economy, including their expectations about financial situations, unemployment, and savings. That's another report that's going to be coming out. And then, just as I mentioned, the ADP employment numbers is also kind of cooperated with the official unemployment rate. And so unemployment adversely affects the disposable income of families, erodes purchasing power, diminishes employee morale, and reduces an economy's output. And so in orange here, I have a note to remind us that when the employment rate is high, the Fed decreases the interest rate, which in turn increases the stock market prices. So this was always very interesting to me because I couldn't really figure out when certain companies or certain times it was announced that unemployment was high. Why is it that the stock market would go up? Why would a particular company, after announcing so many layoffs, would it go up outside of the money that they're saving on those salaries? Why do we see an uptick in the market? And that's because there's this weird kind of relationship where if the economy is kind of doing bad by way of measuring unemployment, then we know the government is going to kind of take its hands off in terms of tightening restrictions and getting access to money. And so, with that being said, more unemployment could potentially lead to the Fed decreasing interest rates, which in turn will increase stock market prices because getting access to money becomes cheaper. And so, if getting access to money is cheaper, then obviously the market makers and the players that be, or the powers that be, can run up the market. So, we want to be aware of those things, and they're very important because they will be announced this week. And so, one thing that I always talk about in PIU, you'll see me quite frequently, either Saturday, Sunday, or Monday mornings. I'll take a screenshot from marketwatch.com and I will drop in what is going on or what's going to happen with the economic reports of the week. So be sure to look out for that and keep that saved to your favorites so you could always refer to it at any given time. But fortunately, tomorrow, Monday, there aren't any expected events or reports. So I like to call it a clean and free trading day, if you will. There shouldn't be anything crazy, but we want to keep our eyes on it and take a look. All right, let's go ahead and hop back to our prep. All right, so playing earnings momentum. What I want you to do, if you are interested in playing earnings, which I do caution against because it's one of the most manipulated times, in my opinion, of the stock market. But we've got big earnings activity coming up for this week. Just to quickly spotlight, you can see all these logos here. All right, we got SoFi, Domino's Pizza, Phillips, Paramount Plus. You know, we've got Fiserv. Oh my gosh, that's just for Monday. We've got Chegg coming out, and then on Tuesday. All right, so we got a notation here about the consumer confidence. We got PayPal, AMD, Amazon, Coca-Cola, Eli Lilly, Starbucks, McDonald's, Pinterest. All of these companies are announcing their earnings. So this is earnings season. We've got Cisco, we've got Ecolab, we got all kind of companies announcing earnings. And then going into Wednesday, we've got Zillow, we've got Pfizer, we've got Etsy, we've got CVS, we've got Carvana, Qualcomm, we've got MasterCard, ADP, my company and my portfolio. Going to be on the lookout for that. So the note here is to go back and look at how the next day performance was after the company released earnings. If you are forced, I'll frame it like that. Let's say you're forced to trade a company's earnings, because I really have had to learn the hard way so many times not to play earnings. So let's say you find yourself where you're forced to play a company's earnings, then I would go back and at least go and look at how the company did in terms of momentum the next day after the earnings were released. And this is a little bit of a caveat right here, which is there are some companies that will release their earnings the day of before the market opens. So go back and analyze how the performance was after the earnings was released and then see what the momentum was like. Typically, if you're forced to play earnings, remember, we're going to use that phrasing and that kind of psychology to kind of caution us against from playing earnings. But if you're forced to play earnings, then what you want to do is ride the momentum either to the upside if the market reacted positively, or to the bear side if the market reacted negatively and the price starts to go down. You don't want to find yourself playing the earnings or getting into any trades before the numbers were or are released. All right, now let's get into some charting, some trading view basics, because there have been a few requests quite directly to me this past week about doing some charting, some videos on charting. We have our bots that go in and automatically let us know when TradingView posts a new video related to the charting software and the new features and functions that are available. But I did want to speak to a couple things that are that I use on a daily basis when it comes to my charting in TradingView, and that includes the use of alerts, indicators, the ability to back test using the replay function, and then charting, trend lines, support and resistance zones, and the display style and settings. So we kind of already touched on that, But let's go back and take a look at TradingView. So, taking a look at the overall kind of style and aesthetic, right? One of the first things that I want to make note of is when you're looking at any time frame, and the time frames are up here at the top left if you're using the desktop app and as well as the web version of TradingView. If you're looking at any time frame that is below the daily time frame, for instance, the 1 hour, you will get this function or this toggle button, the ability to turn off what is known as extended hours trading versus regular hours trading. Now, there are a lot of traders or investors out there that really do not include extended hours activity in their trading strategy or their trading setups. And if you find yourself on that side of how you develop your edge or your style, then you can just look at the regular trading hours, which will get rid of the pre-market or the after hours trading and just focus on what happened during the actual trading day. Now, for me individually, and this is not to tell you what you should or shouldn't do, I like to have the pre-market or extended hours data available on my chart because there's so much data that's hidden from regular everyday retail investors like ourselves that the more data that we have, the more we can make informed decisions when it comes to our setups and our strategies and things like that. For instance, if you're seeing a company completely tank out of nowhere in the pre-market before the market opens up, and you don't see why, right? There's no economic event that's happening, no reports, the company didn't release earnings, that would at least prompt you to go look for some news. Was there a news event, a catalyst that would explain why the market or that particular company is just tanking before the market even opens up? So that's just my thoughts on it. But I did want to show you that you could turn on and turn off that ability down here at the bottom right on TradingView. So there's regular trading hours and then there is extended trading hours. Now, the next thing that I think is very, very cool, and I do toggle you to use this every now and then when it comes to TradingView, is the ability to set alerts. And it's something that I highly, highly, highly encourage all of you to do and get in the habit of, especially if you're working a job where you don't necessarily have the ability to sit in front of the charts all day and you kind of just need to know when a particular company hits a level or hits an area that you need to be aware of to get in and out of your play or in and out of your trade based on your setup. And so the cool thing about setting up alerts on TradingView is you can have them come to your email, you can have them come through as a push notification, all kind of things like that. I've got it set up so that notifications are actually linked and tied to the Discord for PIU. So if there's something that I feel very strongly convicted about, an alert will go to all of us just in case I'm not there to prompt us with an alert to take a look at a particular trade or play. So I'm going to go through really quickly and show us what that looks like. Let's just say we're looking for a certain level on SPY. And if it gets to that level, we know we want to enter into a trade. For instance, let's just say on this low, right? Let's just say we believe on this low that happened on Friday, April 19th, if it gets down here and breaks below, that the market is going to drop, that SPY is going to drop. What we can do is you can add a line or an alert. I like to do it with the horizontal line or a trend line, but you can actually just do it over here on the right hand side by adding the price point. But I do it with the trend line because when I get the alert, I want to visibly see it as well. And I just get the alert. So let's just say once we get down to this pricing area, 493.85, once we break below, we want to enter in puts. Once you draw your horizontal line on the app on TradingView, it's going to open up this little menu option, all these different settings and tools. When you see the clock with the plus, that is adding an alert. Now, it looks like we already got 4 notifications set up, 4 notification settings. But let's start off at the top. And then we have a trigger. Do you want it to happen once per bar, once per bar close, or once per minute? And so I typically only use only once because the market moves so fast. And my trading style and trading strategy is really based on that initial moment and not several times over. And so I'll keep that at the default of only once. And then we've got expiration. Now, TradingView will automatically default to 30 days out. And depending on your style, like if you're swing trading, you might want to just leave that for 30 days out. Me, I've kind of played around with the bringing the expiration closer because, as you all know, I'm more of a scalper, more of a day trader. But because we're in this upward trend, because we're getting more into swing trading, longer plays, we're going to leave this 30-day expiration on here. And then we want to add an alert name. And we can say SPY drop down to recent low dash time for puts. And then after low, we can kind of put in a price point so we know what we're kind of talking about. 493.85. Boom. And then we can take this same thing, put it here in the message. Now, this will be the actual message. So the alert name was just a title. So you don't have to be that extensive with it. You could just put in something simple. But in the actual message, you want it to be as detailed as possible to remind you what you're looking to do and what you're looking for. And then that mixed with the illustrations and the drawing on your charts that immediately tell you what type of trade and what type of play you want to hop in. And then you would just hit create. And so we can go back and you see now the alert icon is highlighted in blue to let you know that there are alerts available. And you can also see the alert icon right under the line that we drew. But if you wanted to go back in here and edit it and go into the notifications tab, you have this ability to toggle on and off, notifying in the app. You can do a pop-up that appears right here. So let's say you're not even looking at SPY or this particular chart. Let's say you're up here looking at Pepsi or QQQ or something else. There will be a pop-up that happens right in front of your face, and you could turn on and off an email. Maybe you're in a position where you not necessarily have your phone in your hand. At least you'll get an email if you're using a laptop or a computer or something like that. That'll pop up as well. And as you guys can see, I got the webhook down here to go ahead and get it alerted to our Discord. All right, let's jump back into it. Hold on, let's make sure we're still rocking solo dolo, which I believe we are. Let's see. Yes, yes. All right. Let's get back to where we were. All right, so we talked a little bit about the settings and we talked a little bit about kind of drawing trend lines, if you will. But let's kind of go into a little bit of the support and resistance zones for the trading view. Now, for most of us, when you're first starting out, you kind of learn about support and resistance by drawing maybe a single line, right, as a point, kind of like how we did here to set this alert. But what I've learned, which has helped me a lot more with my trading, is to draw what's known as a support and resistance zone. Now, if you don't know what support and resistance is, support is basically a level that price does not want to drop below. And then resistance is a level that price does not want to go above. Now, the way that I draw the zones as opposed to a line is by doing a shaded a rectangle area. And I usually shade it in orange. Plenty of you guys have seen that before when I do lives, either on TikTok or some of our weekly strategy sessions from the past. So my eyes can quickly see a support zone right in here. You can kind of see where price stops and starts, if you will. Let me delete this. Over here, going back to February of this year. So what my eyes see is right over here. Boom. And you can kind of see how price respects it, right? So back in February of this year, it kind of broke into the support zone, had a little bit of time trying to break above it to go ahead. It came back down and it stayed in here for a couple of weeks, we'll say, a couple of trading weeks. SPY and the price of SPY, the price action, the movement stayed in the zone. It finally broke above it, went to some all-time highs, and then dropped down. And look how crazy that is. It came right back into this area of support. Like I said, support is a pricing area that typically does not want to go below. And then it kind of struggled to break above. And that also coincides with this trend line that we drew. So we've got the support and resistance zone that it broke above that coincides with the trend of the market or SPY SPY going up. Now, the same thing here with our ability to draw a resistance zone, right? And we'll make this a little tighter, even though it's a bit choppy, where the all-time high was. So we had going into mid-late March, SPY breaking into all-time high areas, had a little bit of support, came up to some more all-time high, if you will, a little bit of support, and then finally it broke down and it came all the way down into the support area. So just take a moment now, and I'm hoping you're seeing what I'm seeing, and an ability to have a trading plan. So let's say you have been just tracking SPY this whole time and you weren't necessarily in a play yet, and you saw that it broke this trend that it was going through to the upside once it reached this all-time high area. Once it broke below, if you had already charted out this zone for support on the daily chart and you were betting to the downside or you were bearish and you got into puts, then you can set a profit target for this area, for the support and resistance zone. So, okay, once it gets here, I know I want to take profits. I don't want to be greedy. I want to go ahead and get out. And if you did, look how you saved yourself, because then we've got a bounce up of off the support and going back up to the upside. So just look at that. Just a very simple strategy, drawing a trend line, drawing the next level of support and resistance as a profit target, and just letting it play out. Boom. So just some real charting, easy basics to add to your trading strategy. That's really all you need. You can go back and do this several times over, kind of see where the trend breaks, where it restarts, where it reverses, add some support and resistance zone, like you can see here. Boom, quickly. You could do another resistance zone here, a support zone right here. And once it broke down, go ahead and enter your calls to the upside. Got back into the support and resistance area. Let's just draw it really quick. Look how crazy that is. We'll keep it kind of tight. Let's draw this really quick. Boom. You can even have played this just for a quick little few days, maybe a couple weeks. Resistance zone, if you will. So let's say you had notated that. You got your push to the downside. Once it broke, you could get out. Once it comes up, do the same thing over and over, just like how we did here. And that in and of itself is a trading strategy based off of some simple technical analysis and charting. And then you have the ability to go into the settings on a chart and do all kinds of things when it comes to your color and your theme. You can go from dark to light. You can change all of that if that's how you want it to be, whatever easier for your eyes. I like the dark theme. You can have it the same as your system. So if your computer is set up to change from light to dark, depending on if it's early in the day or getting into the evening, it'll change that way as well. And then you can change the color of these candlesticks. Sometimes you'll just have to go into the indicators, go into the settings of an indicator. You can change all these colors. I've seen some really cool ones out there. I know some traders out there that use completely different colors as opposed to green and red. I've seen like purple and black. I've seen all kinds of things. So you can really customize it to fit your personality and your style, which is really, really dope. All right. So we talked about the alerts. We talked about some charting. And let's talk about indicators. And I'll probably sound like a broken record, especially if you've rocked with me on my lives on TikTok. But let's go ahead and take a look one more time. And I'm just going to show y'all really quick the indicators that I use on a daily basis, which is the SSS 50% rule indicator, this wedge maker, the strat assistant, which are these numbers under each candlestick. And then one that I don't talk about too often is the daily, weekly, monthly opens. And these are some pretty key levels that are to be respected that you'll see the market respects a whole lot, a whole lot. So we'll go ahead and we will get rid of the wedge maker, even though it doesn't even show that's visible. And then we'll turn off the SSS 50%. So we want to kind of just see what's going on here. And now look at this. Very interesting, right? Because we've got that horizontal line. Now, up here, the red M stands for the monthly. So this was the monthly open, if you will, for SPY. And then we've got the weekly open. So the month and the week, like I said, these levels are to be respected. It came all the way down to the weekly open. So if you look at these first kind of 2-3 weeks of April and how it was in respect to that, and then you could kind of zoom out and see we've got our yearly open. You may even plot this out as another level of support all the way across. And look at this. Look at how crazy this is. Even though it makes sense, right? I wouldn't even say crazy, but it makes sense. We've got our yearly open, which acted as a strong level of resistance for the end of December going into January. So you could kind of even forecast that that level, our yearly open, which is a support and resistance zone, you may be able to drag this all the way across. And if we have more of a push down, set it as another profit target. So for instance, we've got this alert set up that tells us, hey, and this is all off the cuff. I didn't even plan this. This is y'all seeing me freestyle, breaking this down in this little strategy weekly prep meeting for us. We've got this support and resistance zone. We also added an alert that tells us, hey, if SPY drops below this particular level, let's look to enter puts. And if we do, we could set this next profit target for the yearly open of where it started. And that right there, once you get that trim back down, could set up a whole trading play for you. Simple and easy, just using trend lines and support and resistance. All right. And then I wanted to talk about the replay function, right? So the really cool thing about TradingView and a lot of the pretty well-equipped trading platforms is the ability to replay. And this is really cool. And so you can basically go into the past, right? And then practice your strategy by back testing. And then it gives you the ability to have a play function so the candlesticks will appear. But the main reason why I'm bringing this up is there are two things that I want you to do when it comes to back testing, which is depending on how often your setup presents itself, you want to take 1 year. So let's say you go back and manually look for every time your setup presented itself in 2023, just going through using this replay function. Then the next thing I want you to do after you've gone through 2023 is to go to 2022 using the replay function. Let's see if we could do it pretty quick. We'll just do a quick little spot check. And this is what I do. All right, so I've gone through, I manually identified and back tested every time my setup presents itself in 2023. Then I'll go to, let's see, we might have to zoom this out a bit. We'll do it really quick. Let's go to 2022. And now, after I've manually done all of 2023, right? Go to a random time or the beginning of 2022 using the replay function and just let it play out like the market was live and just let it play. And the moment that you see your strategy or your setup present itself before the next candle even appears, hit pause, look at your trading setup backlog, and if the setup was to completely align with your trading strategy, imagine yourself taking the trade. And one thing that I do, and I've been doing this more and more, I actually recently just started it, I actually use a couple of physical dollars in my hand, and I'll say, okay, I'm taking this trade. It falls right in line with my trading setup. I put it right here by my keyboard, depending on how much I want to, what contract I want to say. So I've got $5. I've got $10. This is going to teach me about risk management, being greedy, over leveraging, over trading, however many physical dollars I have using the replay function. So currently, just quick, I have about 25, $30. So out of my 25, 30, we know we don't want to use the full amount. So let's just say I'm just going to use 5 for this particular trade. I put 5 on the keyboard, let it play, make sure I have my profit target, my stop set, and whatever happens, if it works out, I keep my 5 and I get another 5 that symbolically represents profit. And that's the way that you kind of do some quote unquote back testing and paper trading, if you will, with a little bit of money on hand as opposed to just doing it digitally, which you can do and you should do as well if you want to get more experience, which is using paper trading. But that's what I do. You go back, do 1 full year where you're manually identifying and seeing your setup play out, then go back to another year in the past before, and then just use the replay function. And when the setup presents itself, see how much you in particular want to put on that trade, and then see how it plays out and just stick to, hey, did my backtesting log and my trading journal and my trading setup say I was supposed to take this? If yes, we're going to rock with it and let it see how it plays out. And you can just do that right here with this play function going through on TradingView. And we can see these candles just appear. We're back in April 2022, which is kind of crazy because I just randomly chose this. And here we are in April of 2024. But you can even automatically see with your eyes, we've got a support and resistance zone automatically identified right at these levels, which is at 457, which is pretty strong. But that is the long and short of the replay function or back testing. Go ahead and hit that pause button. We'll exit out. We'll go back to where we were in present time, present day. And then let's just take a quick little tap in, see if anybody's rocking with us. If not, all right, let's keep it rolling. Okay, options mechanics. So a couple of things that I look for when it comes to my options contracts and things like that. I want to talk about contract activity, IV or implied volatility, expiration, and pricing. So when it comes to contract activity, the long and short of it is I'm looking for contracts that have a whole lot of open interest and volume. And so I'll show you that because I think I've got Robinhood already up. And let's see, we want to kind of get out of this. It's weird. All right. How can I? Got myself a little jammed up right here, but here, this is how we're going to maneuver and do this system right quick. Right. Let's go ahead and do another new window. Yeah, I thought I had Robinhood already ready to rock and roll. Let's just double check one more time. That's it. No, no, no. Okay. Well, we'll just go straight up and take a look at Robinhood. See here. Move myself over this way. All right, so what we wanted to take a look at is the options, open interest, and volume. And let's just go to SPY because we've been rocking with SPY for the sake of getting this weekly strategies session going. Right? And it says the securities on the 24. We don't want to do all that. Hold on. But really quick, so we can spotlight this. So we've got the options chain. This is what this is known as. So the options chain is just a list of all the available options for a particular ticker. Shows you the price for all of them. Looks like the market is open right now, and it's Sunday. This is my first time experiencing this, so we're rocking together. But what I like to see when it comes to open interest and volume is high numbers like that. And this basically is a representation of liquidity. And why liquidity is important is because it shows your ability to get in and out of a contract very fast. I'm going to break it down super simple. The higher the value and open interest is, the more players there are that are going to be willing to buy or sell your particular options contracts. When we see volume and open interest below the thousands, below four figures, you typically want to exercise caution when buying those contracts. What we want to see are things in the thousand. Now, that's not going to be every trade, of course. It's going to happen where they're not in the four figures or the thousands. But when you're dealing with ticker symbols like SPY or QQQ, it's going to be easy to find open interest and high volume. Now, just to let us know, for those of us that don't, volume represents the number of contracts that were traded for that particular trading day, and open interest are the number of contracts that are still outstanding or that haven't been exercised. So it's good to see, okay, we've got this many contracts, not necessarily the number of people, but this many contracts that are still at play. All right, we can shake back to our options mechanics. Okay, we're talking about expiration. So, or getting ready to talk about expiration, and then I'll jump back over to IV or implied volatility. But the expiration for the way that I play my trades or my contracts is very simple. I look for at least a week out if I'm doing scalping. And just a reminder, my definition of scalping is basically getting in and out of a trade in less than 60 minutes. Now, I have faced some criticism when it comes to scalping or the way that I do with the expiration dates for my contracts because you really don't need more than a day or two when your contracts expire if you're going to scalp. But I do like to have the ability to have the theta be low and not working against my contracts so strongly or actively. And so that's why I look for at least a week out when I'm doing my scalps, at least a month out for day trades and swings. So if I'm going to do a day trade, meaning I'm going to hold it for more than an hour, a couple hours, or I'm going to hold it for a day or two, I'm looking for contracts that expire at least a month out and then at least 6 weeks out for swings if I plan to hold for a week. So I'm going to hold for at least 5 days that I want my contracts to expire 6 weeks plus out. And the main reason why I'm trading this way is because I really don't like the idea that theta is, which is time decay, eating away at the value of my contracts. That really bothers me. And I don't even like seeing the theta number higher than the delta. I know it's kind of quirky, it's kind of cheesy, but that's just the way that I give myself some added relief and alleviate some of the stress and maybe even like anxiety that comes with taking some trades. When the theta is way lower than the delta, I just ease into my contracts and my trades. And then when it comes to pricing, I like to get as close to in the money as I can get while still being able to buy multiple contracts, right? And the reason why that's important is because having multiple contracts will allow you, right, to scale in and out of your trade. So let's say you buy 10 contracts and the trade is working in your direction or your favor. You can sell 7 of those contracts and let 3 of them run to see how they pan out. But if the contracts are super expensive and you can only buy one, then you don't get that ability to have some control over your trade in that regard. It's a one and done, you're in and out, and you got to sell. And if you've been in PIU and you've been seeing me these past month or so, you know that me scaling out of trades, me letting winners run is something that I'm working on developing and getting outside of my comfort zone. Right. Let's get back onto our grizzle. Oh yeah, and then when it comes to implied volatility, typically I like IV to be less than 30%. The higher the IV, the harder it will be for price movements in your favor to positively impact your options value. And so this is another thing that comes back to earnings. What you'll see during earnings times or close to a company reporting earnings is that the IV will be outrageous, especially for companies that everybody knows that are super popular, right? Your Nvidias, your Netflix, your Apples, your Microsoft, things like that. The implied volatility spikes. And when you see that number near 100 or over 100%, even if the contracts, let's say you have calls, move up, if the price of the stock moves up, if everything is moving in your favor, when the IV is insanely high or is higher, even with the value of the stock price going up, your options contracts will still drop in value. And the reason why is because it's basically the market saying, yeah, we expect the price to go up. So, woo-ha, you haven't really done anything special. Everybody knows the price is going to go up. So I typically, especially on a daily basis, if there isn't a big economic event or earnings or anything like that, I like the IV to be below 30%. I've seen, at least for my contract performance, they've done much better when IV is below 30%. All right, lastly, just to wrap it up, I appreciate y'all for rocking with me when you're watching this video in the future, getting the recap. Remember, we've got the Passive Income University referral member affiliate commission program. So, with the affiliate program, anytime you get somebody to sign up for PIU, you will get 50% of their subscription or membership fee sent directly to you. We'll split it. This is one of the many ways that I'm getting to be able to give back to the community. So I want to remind y'all of that all the time. If you got any questions about the affiliate program, just let me know. I'm pretty sure you guys are all aware the way that PIU is set up is that new members get the first 30 days free. And then after that is $10 a month. So at this moment in time, with this current price structure, if a new member signs up with your affiliate link, you'll get $5 a month, and we'll be splitting that. So 5 and 5, or 50% and 50%. But with that being said, I appreciate y'all for rocking with your boy. Go ahead and make sure you hit me up in the Discord. If you have any questions, I know I'm available for y'all. All right. Peace.